Hello. Hi everyone. Hey, so thank you for having us at DAO here today. Super amazing conference. Love it. So I'm really delighted to speak to you about Nala today. So Nala is a new liquidity and staking DAO that is focused on the emerging decentralized derivatives kind of layer to this emergent, decentralized financial system that the previous speaker was speaking about. And the title of today's topic is Lucy in the Sky with DeFi. That's just a play on the fact that we've had a go at reinventing or reimagining how liquid staking derivatives can work. So we'd like to take you guys through that, but we'd also like to speak a little bit about what Nala DAO is and what it's all about. And so just a little bit about me. I'm formerly a commodity derivatives trader, turned DeFi head in the last sort of 4 years, been working on decentralizing derivatives and also decentralizing that market ownership economy, which I think is super interesting and useful as we emerge as a society that is more open and more fair. So, as I said, to kick it off, I'm going to speak a little bit about Nala. So, who is Nala? Actually, we formed as a bit of a collective. It's people from all sorts of walks of life. We have just the most amazing people. We have derivatives traders, we have data scientists, we have quants, we have engineers, we have systems engineers, we have NFT collectors, we have DeFi apes. This is a group of people who have come together who are really interested in this reshaping of the ownership economy and how the DeFi derivatives ecosystem sort of grows over the next 6 to 12 months. And in particular, as we've been talking about things that are important to us. Defending decentralization, super important, and making sure that we are helping and pushing and participating in increasing decentralization in these markets. So removing unfairness, removing economic barriers, removing knowledge barriers. And we're very passionate about radically open markets. So these are markets that are owned and run by communities. So we basically agree with Arrington Capital's report that they put out some months ago that basically summarize this as there's a space race for derivative markets that's looming. And it's because as derivatives markets become cheaper to create, you can start to bring the existing markets on chain. You can, when the trade life cycle is fully decentralized, you can run basically all of the current derivatives markets on chain. But what's also really exciting, and just to paint the picture here, the current size of the traditional derivatives markets is massive. It's hard to even understand how big it is, and it's because it's much bigger than the sort of net wealth of assets in the world, and that's because derivatives are all about trading future outcomes. So, some people might be worried that they just want to cap some particular risk, like maybe it's gold. Let's talk about gold. Like maybe they want to hedge against gold plummeting to a particular level, or somebody else wants to lock in a price for gold, or someone else wants to hedge the other direction, or someone else is worried about the volatility of gold. So you can have many derivatives that are created on that same underlying. And that's what makes derivatives so huge. But here's the thing. We believe that actually derivatives markets can be much bigger. So firstly, as the previous speaker mentioned, there are a lot of people that are excluded from using derivatives markets. The World Bank did a study that showed only 5% of African companies use derivatives compared to 85% of UK companies. And that's just a big disparity in terms of adoption of these markets. And the reasons that were sort of investigated or highlighted in the study were, just lack of access primarily, and, lack of sort of education and knowledge on how to use these markets. And so we believe that onboarding the currently excluded people is going to be a really powerful aspect of decentralized derivatives. But then also, really excitingly, is we're going to be able to empower this sort of creative creation of new markets. And so if you think like micro-sized markets or ephemeral markets that can spring up quickly in response to a particular event. So after the pandemic, I'm sure that there were, investment banks and high net worth clients doing derivatives to help hedge their pandemic risk, but that wasn't really open to the normal, small, medium enterprise or individual. So responsive markets, I think, will get really creative and exciting as you see AI type, logic spinning up markets that we don't even know about for, efficiently distributing, efficient resource allocation, basically. And that forms a component of this magic internet society that the previous speaker spoke on. So Nala really exists to build this new paradigm. Protect against whale-owned infrastructure and markets, turbo boost the market ownership economy, and also just provide easy pathways to participation. Because we know derivatives are a kind of complex and strange thing for many, many people. So, in essence, as I said before, Nala is a liquidity and staking DAO for decentralized derivatives. And what Nala is building is essentially that application layer for DeFi derivatives to open up this infrastructure to those who are currently excluded. We believe it's really important to also be participating at the infrastructure layers. So Nala is running a node on Vega and will continue run other nodes for the sort of multi-chain DeFi world, basically, and also engage in that decentralized governance at the infrastructure layer. But today, what I really wanted to dip into really quickly is what kind of investment and staking pools, the kinds of things that Nala can launch to abstract the complexity away and allow people to participate in these markets. And as promised in the title, we'll also have a look at liquid staking. Right, so Nala sort of vaults and pools. This is a way of launching products similar to, as you've seen, other protocols do, but again with a focus on abstracting away the complexity of dealing with derivatives markets. So the thing that makes derivatives markets difficult is often they're traded on order books. They are often require a lot of post-trade management. So once you open a position, there's margining, rebalancing that needs to happen. So they take a lot of there's a lot of the liquidity protocols themselves are also quite complex. So the idea is to provide some ability for people to passively put their capital into a vault, and we, as traders and data scientists and so forth, are building out integrations to the DeFi protocols that are out there. So there's various types of vaults and pools you can get, and it's kind of what's really exciting is that you can bring, using derivatives, you can actually bring real world risk on chain. So non-crypto native exposures can be natively traded on chain. So things like, what will happen to the oil price, index tracking, for equities, this kind of thing. Even trading things more complex like volatility spreads. And I think there's some interesting products that will emerge as we dig in and we get innovative and creative with our community around, even on-chain native risks that would benefit from being hedged. I mean, you've seen hash rate futures as an example, but I think there's a whole layer around the data provisions, so Oracle Insurance as well. So these are things that we will develop out with the community, and over time we will be sharing this intellectual property so that the community themselves can build vaults, and hopefully we'll get that kind of social trading happening as well. Right, but promised to talk about liquid staking derivatives. So I want to talk through the typical liquid staking model is that on a proof-of-stake network, there is a governance asset that is used to help secure the network. And basically what this governance asset is it's like an option to always be able to stake and get a return for having staked. So embedded into the token is this sort of perpetual optionality forever. And so what the typical liquid staking design is, and this is very simplified, but basically you create a smart contract that sits between the proof-of-stake blockchain and the holders of the token, and people can deposit into that smart contract instead. And that smart contract will then delegate onto the proof-of-stake blockchain, and the proof-of-stake blockchain will return to that smart contract any staking rewards, which they will then distribute back. And there's various reasons this has emerged, and any of you who have been familiar with Lido or played around with that will know that there's with Ethereum too, there's like a minimum size limit to be able to participate in staking. So the liquid staking contract can act as an aggregator. But also it can give more favourable sort of entry and exit type conditions. But I think the most exciting thing, or the most compelling aspect of liquid staking, is that it allows you to simultaneously exercise the optionality in your token and collect the staking rewards, but also basically take that token and say, well, hey, I've got all this future optionality and this future value inherent in the token. I want to be able to use that as collateral in the DeFi ecosystem. So as we started to think about, because we're a validator on Vega, we started to think about offering a liquid staking service. And so as a derivatives trader, I started to think that, wouldn't it be great, for a system like Vega, where the future yield is basically uncertain, it's not a fixed yield, it depends on how much trading and adoption of the network there is. Wouldn't it be cool if I could sell parts of my future optionality? So I could maybe sell some of the forward returns without forsaking the full optionality of the token. Or alternatively, if I was intending to use Vega, I was gearing up, I was creating an integration and I intended to use it in a year's time or 6 months' time or something, I could purchase ahead of time the Vega tokens I wanted, but I wouldn't have to purchase between now and that 6-month period. So basically giving a little bit more granularity around your sort of forward curve and your forward management of your exposures and risk and portfolio. And I was kind of inspired by the power markets because they are, in the power markets there's a floating unexpected spot price, and so participants don't typically want to wait and see what that yield is going to be or that cost is going to be. They want predictability. So the NALA's liquid staking system, and we're really seeking feedback on this, so please don't hesitate to come and say hi and chat about it. But basically what we're thinking is that if you lock a stake token into the liquid staking contract, and then that liquid staking contract, just like the previous system, can delegate to the proof of stake network, receive the staking rewards. But instead of getting one token back, you actually get multiple. And those multiple really represent the forward slicing in time of your option on the yield. So to do this, to achieve this, the system works where there is a perpetual ownership token. If you could see, sorry, I didn't realize you can't see me pointing. But there's a perpetual ownership token. So this is sort of like whoever holds this is able to get back a potentially Vega token. This is the example we're using at the moment. Also, whatever the current spot period is. So say this liquid staking smart contract was configured to slice into quarters. What it would mean is, and I put my token in, I would get back a perpetual ownership token, I would get back the Q4, because that's the current quarter we're in, and then I'd also get back Q1, Q2, Q3, etc. for next year, and in future years. And in fact, how far out that goes is also just configurable within the smart contract itself. So basically up to the community and what it thinks is useful. So let's walk through a little example to show why and how this could be useful. So say today, if the NALA liquid staking smart contract was created, what somebody could do, so we'll use Lucy. Lucy, if she were to hold 400 Vega tokens, for example, and stake her Vega on the NALA liquid staking derivative smart contract, she would receive this series of tokens out on the right over here. This is, by the way, just an artistic impression. A friend of mine's an artist, and she drew this as an artistic impression of the design. The size and width of the pipes or anything doesn't mean anything. But the point is you get these series of forward tokens. So you get the perpetual ownership token, the current token, and the 4 quarters, for example. Now, say she just wanted to get some money today, maybe, let's say, or it's one way to think about it. She could, first of all, her spot token is already starting to earn rewards. Admittedly, this would be if Vega is live, and it's not quite yet, but in the instance it was. But what she could do is opt to sell forward her Q122 token, for example. And so maybe she sells it to Alice. Maybe it's 4 DAI per token. And so we've got, Lucy receives 1,600 DAI today, right? Now, this transaction could have all happened in a decentralized way. Lucy doesn't need to know Alice. Alice doesn't need to know Lucy. It could be facilitated through some other DeFi, matching mechanism. But in any case, Lucy receives that DAI today, and Alice receives the token. So she now has the token, and it's a completely credit risk-free arrangement. Alice can now know that she is going to automatically, just by holding that token in her wallet, she doesn't even have to do anything with it. She is going to be able to claim the rewards of the staking rewards over that future period. So let's fast forward to the end of Q122. Alice has, received all the staking rewards through Q122. And what the effect of this is that Lucy is essentially locked in her token reward. So it's locked in her staking reward to be $4 DAI over that, per token over that Q1. So it's another way to think of it. It's like swapping fixed for floating. Floating for fixed. Now, look, if the staking returns end up being higher, then Alice sort of profits. That's great. I presume Alice has only purchased these thinking it would be higher, or at least has a reason for purchasing it that has something to do with the rest of her portfolio. Maybe it's hedging some other risk. And as I said, Lucy's achieved a sort of certain financial outcome, but hasn't had to forsake all the optionality within that token. So I think what's compelling to me about this is that both parties have traded a future outcome, but without taking on credit risk. And as a derivatives trader, I think that's kind of cool. So the Nala liquid staking derivatives components, so you've got a market operator, and they are the ones who liquid stakers interact with the market operator, and the market operator issues the tokens. And, as time ticks over, obviously some tokens are becoming, they are rolling through and becoming, in the past or expired. And so the market operator will have a schedule for issuing new ones. Conversely, if a liquid staker collects all of the currently issued tokens, so the full basket of like the proof of the perpetual ownership token, the current spot and all the forward tokens, and submits it to the market operator, they can get the original token back. The clearer is the one who's responsible, or the entity in the system that is responsible for distribution of the staking rewards. And that distribution happens to the holders of the spot tokens, as I said. There's some interesting problems that we're working on around this in terms of, scalability and, how it kind of works with as low gas as possible. So we've had some interesting sort of ideas around that. Really happy to talk to you guys about it. The governor is basically helping use the voting weight that is being delegated. And that will all happen through the DAO very transparently. And you can actually have a vesting ballet. So this is just because I know that a bunch of tokens in the Vega ecosystem anyway are going to be locked up for the next year or so, or more. And so the vesting ballet, and they linearly unlock. So rather than having to kind of re-stake, liquid stake every day or whatever, the ballet can handle that for you. And then the key, really important thing is that the liquid stakers are then able to use these tokens out on the DeFi protocols. And all of the forward tokens, like not the current spot token, that's a little bit more complex, and I'm happy to dig into that, if anyone's interested. But all the forward tokens can get traded very easily. They can be traded off-chain. They can be traded through most DeFi, sort of matching algorithms and pools and whatnot. So our liquid staking roadmap, we've written the slide paper. It's in draft, seeking community feedback. We've had some really great feedback. There are a bunch of other, token splitting type approaches out there. I haven't seen one yet that token splits over time, and we're lucky to have the founder of Prism Protocol that's operating on Terra also advising Nala. We're working on a technical design currently, and there will be some implementation, auditing and testing, and hopefully launch Q1, Q2 next year. So I think I'm pretty much out of time, but I just wanted to wrap up to say, just to remind you, like, our thesis is that decentralized derivatives is really the last piece of DeFi technology that's kind of yet to be solved really well. I think there are some really compelling solutions coming to market now. But as they do, we expect there to be a Cambrian explosion of new markets, and we're really passionate about building out this ecosystem. So if you're interested in helping us out, please come and join us on our Discord. I think we have some contact details here. Thank you.